Hi there, I'm going to show you today a question that appeared on the recent F9 exams, ACCA, on the December the 6th, 2013. Now, I'm going to do today question number 2. Okay? Question number 2, it's a question regarding your capital structure and your cost of capital. Now, look at the required here. It says calculate, it states calculate the cost of equity. Cost of equity of CAD using the dividend growth model. 3 marks. Straightforward. Discuss whether the dividend growth model or the CAPM model, capital asset pricing model, should be used to calculate the cost of equity. So this is a discussion which is the better method. Dividend growth model or CAPM model. 5 marks for that discussion. Bonus marks all this. Calculate the weighted average cost of capital of card company using a cost of equity of 12 marks. So 12%, 12%. And it's going to give you 5 marks for that. So this 12%, you may get 12% here, you may not get 12%, it doesn't matter. Just use 12% for this particular part C. Next part of this question, they say calculate a project specific cost of equity, risk adjusted cost of equity, risk adjusted, a project specific cost of equity for card company for the planned new joint venture. But probably they're going into a new business operation. They need to find a new cost of equity that reflects the new business risk. And for that particular part of the calculation is going to be 9 marks. So far we have 3 calculations, which is going to give us 3 plus 5, 8, 8 plus 5 is 12 marks. So the balance is going to be for discussion. Now this is going to be a discussion element. Part E, discuss whether changing in capital structure of the company can lead to a reduction in its cost of capital and hence increase in the value of the company. So it's linked to 3 things. One is cost of capital. One more is the cost of changing in the capital structure. Changes in the capital structure. The next one is going to be cost of capital and how does that reflect your value of the company or the value of the firm. 8 marks here, total 25 marks. It's a balanced question about discussion and element. Now, looking at this paragraph, first paragraph, let me just call it first paragraph. Card company has in issue 8 million shares with an X dividend market value. Okay, it has 8 million shares with an X dividend market value of 7.16 per share. A dividend of 62 cents per share for 2013 has just been paid. The pattern of the recent dividend is as follows. So what are they trying to tell you? What are the important things down here? 8 million number of shares. Very important. In financial management, just look for the number of shares, which is already given. And then you're told the X dividend price. That is good. If it's cum dividend price, then you have to be careful with the dividend that you got to take it out from the price. In this case, it's fine. 7.16. A dividend of 62 cents per share, so it's good per share, has just been paid. Just been paid means the price is X dividend price. Even they didn't give you the word X dividend, it's X because the word just been paid. The pattern of recent dividends. Now, whenever they give you the pattern of recent dividends, they're giving you 4 years of dividend. Well, this figure ties back with this figure that you just got here just now. It ties back with this figure. 62 cents, this is the same figure, So we are told that the historical dividend growth, this is going to be 15.1, growing and growing and growing. So we can come to a conclusion. There is a growth in the dividend rate. Now let's call this second paragraph. Card company has also in issue. Card company has also in issue 8.5%. Now that will be the coupon rate of interest. Now this is going to be the coupon rate of interest. Bonds redeemable in 5 years time, so it's a dated bond. Well, you're gonna have some complications about finding out the KD in this case, with a total nominal value of 5 million. Now, nominal value is the value in your balance sheet, 5 million, not the market value. All right, no, it's not the market value. The market value for each bond is for each $100 bond is 103.42. Redemption will be at their nominal value. So what are the important points here? The points are 8.5%, 5-year bond, valuation 5 million, 103.2 per 100 will be at par. Yeah. The third paragraph will be card company is planning to invest. Okay, this is going to be, it's planning to invest a significant amount of money. Now, when it's significant amount of money, it's a big amount, into a joint venture in a new business area. New business area. It has identified a proxy company or similar company with a similar business risk to the joint venture. The proxy company has an equity beta of 1.038 and is financed 75% by equity and 25% by debt on market value basis. So this one we will come back and see. This is for you to find your risk adjusted WACC. Alright, the next paragraph is going to be the current information on the current RF rate. This is 4%, and the average equity risk premium is 5%. Equity risk premium is, careful with the word premium here, is actually return on the market take away return RF. RM minus RF is 5%. Card company pays a profit after tax at the current rate of 30% per year and has an equity beta of 1.16. So what is important here in this particular paragraph, it's going to be RF 4%, equity risk premium 5%, tax rate is 30%, and the equity beta is 1.6. This is for your current business. This is for your existing business. Okay, this is going to be for your existing business. And let's have a go at this answer. Part A, calculate the cost of equity using the dividend growth model. Okay, let's try this answer here. Part A, we're going to write here cost of equity. Let me go very slow so that everyone is very clear with this answer. Equity, cost of equity, KE in short, using dividend growth model. Let me put it dividend, DGM. Okay, now what are we going to do now is I'm going to write the formula. Make sure you write the formulas. It is D1 over PO plus G. D1 is simply DO 1 plus G over PO plus G. D1 is simply dividend in 1 year's time. DO is the just paid dividend or just declared dividend. In this case, it's just paid dividend. It's given in this paragraph number 1, 62 cents. Okay, and we are told about the price of the share, which is X dividend price. Is that okay? It has to be X dividend price. Next one is going to be a growth. Now growth will be estimated. Growth will be estimated using the historical method, historical growth method. Okay, the formula simply is going to be n number of years, latest, earliest. latest dividend divided by earliest dividend, take away 1. So we're going to write down the figures from this question. Now it has 4 years of data. Now it has got 4 years of data. You got to be very careful here. From here to here is considered 1 year of growth period. Here to here is considered 2 years of growth period. And here to here is going to be 3 years of growth period. So this is going to be 3. Latest means the new dividend. The latest one. The latest one is 62 cents. So let's call it in cents. No worries about that. Or you can call it in dollars. 62 cents, and the earliest one is 55.1 cents. Okay, giving you an answer calculated properly, you're going to get around 4%. Okay, this is going to be 4.01. I'm just going to call it 4% growth. Now we are ready to put in the figures to get our 3 marks. DO is 0.62 multiplied by 1 plus G, which is 0.04 over 7.16, which is your price, plus 0.04, and you're going to get 3 marks here for writing this 13%. So obviously there'll be marks along the way, but this will give you probably 1 mark, 13%. So you're going to get a cost of equity of 13%. Now, that's it. That's the 3 marks. Straightforward question. Now, next thing what we're going to discuss here is discuss whether dividend growth model versus capital asset pricing model, which one is better. Now, I've written the answers down here. Let me just go through very quickly. KE using dividend growth model. Okay, let's talk about KE using dividend growth model. Can be used for companies that are paying dividends. So these are good for companies that have already have dividends each year, either with or without the growth. So that's the first point that I would like to stress. This is my first point. Yeah, KE using dividend growth model can be used for companies that are paying dividends for each. Now, second point I'll stress is using this method, we also require a price. Now, you need to talk about some problems here. The problem about this method is you need a price, which means only listed company can determine this way. Is that clear? Only listed company can determine this using this dividend growth model. Now, this model has its drawback. Now, what are the drawbacks in this model? Using historical growth rate. Yeah, using what? Historical growth rate. They are using a historical G. Let me change. Okay, highlighter. Using a historical G to say future G will be unrealistic. Yeah, will be unrealistic. Yeah. Dividend policy may change for companies. So if your dividend policy changes, what's going to happen to your cost of equity? It's going to change as well accordingly. The company that have nil dividend policy, some companies don't pay dividend. Does that mean the cost of equity is nil? It's a question mark. Probably you don't have to answer in exam. Just leave it open. Does not directly take into account risk. Yeah, this is a key point that I would like to stress. This method does not take into account directly the business risk and the financial risk in its calculation. This risk, okay, indirectly may be reflected in its price. Okay, it may be reflected in its price only if the market is efficient. So if your market is not efficient, the price may not be true reflection of the existing business and financial risk of the company. So what I'm trying to say here is that this price may be wrong, therefore this cost of equity using this model may be wrong. Now, cost of equity using the CAPM. Now, cost of equity using the CAPM now, okay? Now, will be more accurate, yeah? I'm starting my answers with this straight away. It's going to be more accurate as it considers risk into the calculation of its beta equity that reflects systematic business risk and also financial risk. Then you say, so this is superior. This is superior because of this. But it also has its drawback. Again, only listed companies can find its beta equity because beta is actually the slope of the regression line R, M, and RJ. That is the price, the return on the shares. Right? It's a slope on the regression line. You don't have to go into that detail here. Just remember that if it is listed company, you can find your own beta. But if you're unlisted, no worries. You can use similar proxy companies to find the beta. So that's the first drawback. Not all companies have its own beta. And also beta are statistical data. Yeah, it's a collection of prices movement as well as the return of the market movements. And beta, therefore beta can change over time. All these are historical. Next one is assumes shareholders. Now CAPM model assumes shareholders are fully diversified, which means they are not exposed to any unsystematic risk at all, which is not true. How many of our shareholders are having a widely diversified portfolio? Not many. Problem in finding RF and RM. Yeah, problem in finding RF and RM. That's going to be difficult task. It's moving every day. Okay, so this is what I would write for part B in general to get the 5 marks. The next one is going to be straightforward 5 marks question. Calculate the weighted average cost of capital and using cost of equity of 12%. Now if you notice just now, the answer that I got in part A was not 12%, it was 13%. So you might panic. Yeah, in exam you might panic. Oh, it could be wrong. But there's a reason why the examiner have given you 12% is because he have actually used CAPM model to find 12%. Yeah. So what I'm going to say here is I'm going to start my answers. Yeah. Okay, let me go down. Okay, I'm going to say part C, weighted average cost of capital of card company. Yeah, weighted average cost of capital of card company. Well, actually cost of equity is given. Yeah, cost of equity is given at 12%. Now I'll show you how examiner got 12%. Here I've used CAPM, which is 4 plus market risk premium, which is RM take away RF, multiplied by the beta equity, which is given in the paragraph number 4, which is 1.6. So you multiply by 1.6, put in your calculators, figures in the calculators, and you should get 12%. Anyway, it's given, you don't have to waste time doing that in exam. Now, cost of debt is actually for the bond. Now, I'm going to take a different approach here. Cost of debt is for the bond, and it is a dated bond, which is redeemable. Okay, cost of debt bond, which is redeemable. Your examiner likes this approach using IRR. Using IRR, interpolation approach, which is actually your yield to redemption. Is that clear? This is actually your yield to redemption method. Okay, using IRR, yield to redemption method. Now to do this method, let me go through the question on this paragraph number 2 in detail. Now, Card company issued 8.5. 8.5 is the coupon interest rate bond, redeemable 5 years time, nominal value 5 million, bond price 103.42, redemption at nominal value. Okay, the key things here. What is important if I want to use IRR approach? So this is going to be in year time 0, year time 1 to 5, no tax delays. So it's going to be year 5. Now this is going to be my market price of the bond. This is going to be simply my interest rate, and this is going to be my redemption value of the bond. And I'm told here, we are told it's 103. This is going to be my cash flows. Okay, this is going to be my cash flows. 103.42. Taking investor perspective, we'll put a bracket. He's going to take out this money, and on top of that he's going to get something. Now he's going to get 8.5. Now this is company's cost of debt. Companies can save tax at 30%. Okay, so eventually the company will feel they paid 8.5. They've paid 8.5, but the tax rate is 30%, so the savings will come in. So eventually they will feel that they have paid an interest at 5.95 per 100. Okay, per 100. And redemption value, question says here clearly it's at nominal value. So this is going to be 100, and the discounting factor, it's going to be the first discount factor. Now you need 2 discount factors to do these calculations. Yeah, you need 2 discount factors to do this calculation. This is going to be present value. This is going to be another discount factor. This is going to be present value. Anything, you can go with it. Now you can choose any figures you like. In exam, there's no rule saying you have to use that rate. You can use any figures that you like. If you got no time in exam, just choose one figure at 0%, because 0% everything is 1, and another figure anything you like. But I would like to show you the better method. Now you have to understand how the cost of debt is related. Yeah, if you notice the present value and the cost of debt, or the discounting factor, it's always a slope downwards. So if you choose one rate here, maybe let's say maybe 10%, and one more it's at maybe 20%, for example, and when you do the interpolation, you're going to get this as your IRR. When your true IRR is this is what you get. This is your calculated IRR. This is going to be your true IRR. So there will be a margin of difference here. No worries about this in exam, okay? You don't have to worry. So will it be good? Will it be good if you can get one of these PVs here, and one of these is going to be one of the smallest NPV? So if you do the interpolation, you take a long ruler, okay, you take a long ruler and you connect them here, and it looks like this is your calculated IRR and this is your true IRR. It happens to be the same. So if you got time in exam, you look for the 2 rates, which is going to give you the smallest positive NPV, and one more rate for the the smallest negative NPV, I would say. So how do you do that in exam? You have no time to find one by one. So I would recommend you this method. Now I'm going to show you this method, cost of debt approximation. Okay, this is cost of debt approximation. Now cost of debt approximation is simply similar to this method. This is an modified. Now I modified this method using this thing called ARR. Okay, ARR. Try this and see. Take 5.95, multiply. Okay, this is profits. Now we're going to find profits. You're going to get 5.95 for how many years? you're going to get 5.95 for 5 years. Okay, plus on top of that, you're going to get $100. These are my inflows. These are my total inflows in the business. Okay, then what are you going to get? To get all this, to get this figure, you have to invest the figure, which is going to be 103.42. So what do you get actually here? Sounds like profits. Okay, it sounds like profits. You just divide it by 5. So you take that figure, you divide with 5, you're going to get average profits for a year. So if you get average profits for a year, you're going to divide with your investment amount, opening investment. What's your opening investment? 103.42. What's your closing investment? Deemed to be your redemption value? 100. What's the average of these two? It's going to be divided by 2. Press your calculators. Press your calculators. This is going to be your return, and this is going to be your investment. So it's actually return on investment, which is going to be the yield on the investment, which is equals to multiply by 100. Okay, if you multiply by 100, you would get 5.17. From my calculators here, I got 5.177. I'm just going to show you some differences in answers. Okay, 5.177. Okay, so I've got a cost of debt 5.17. Looking at it, it's around here, 5.17. So if you really want to stick to IRR method, now if you really want to stick to IRR method, I would recommend you to use first discount factor 5%, because it's 5.17. If you look at it here, it's 5.17. And probably here I would choose a rate, depends on what's the outcome here. If this is positive, this is positive. If you have time in exam, look for a negative. If you don't have time, don't worry. Just stick to whatever you have. Just stick to whatever you have and put in the formulas and do the calculations. Okay? Don't worry about you not getting a negative or whatsoever. Now, but this method will give you one positive, one negative. Yeah, 5%. So looking at your calculators or your discount factors or some formulas, pressing the buttons, you're going to get here 1. Recall the memory, you should get 4.329, and this is going to be 784. Yeah, this is going to be 784. You multiply with this figure, you're going to get 103.42, and this is going to give you 25.76, and this is going to give you 78.4, and putting it across, you're going to get a positive PVs of net of 74 positive. So if this is positive, so you just got 5%. So you just got 5%. One is positive. So the next one I will try here, 6%. Now let me tell you. Let me just change my color for this one. It's just black. Okay, this is going to be 6%. Now 6%. We'll hope that we're going to get negative. We'll hope we're going to get negative, but don't worry. This method gives you a 99.99%. It will be a negative. So this is going to be 1. Looking at the table of calculators or the formula method, so it's going to be 4.212. This is going to be 747. Careful when you multiply, all right? Careful when you multiply this. Many students tend to, sometimes myself as well, tend to multiply with this. Take this, multiply with this. Yeah, I'm sure you know at this level, especially after your exams. So this is going to be 103.42. This is going to give you 25.06, and this is going to give you 74.70, and you will have a negative figure of 3.66. So you have got 0.74, 3.66, and we're going to find cost of debt. Now, cost of debt using the IRR interpolation method, where you take the small rate. Yeah, what's the small rate? 5% plus small rate NPV. Small rate NPV is 0.74 positive. Then you're going to get 6 minus 5, which is small v and small a. The rates, yeah, smaller rate, bigger rate, and then you're going to get 0.74 minus minus, yeah, minus minus. In school they teach you plus, so you're going to plus with 3.66. there you go. You're going to get an answer. Press at your calculators, you should get 5.17%. So now what am I trying to tell you here is, I've seen the marking scheme of other questions, yeah, similar to this cost of debt. Now they always give you 1 mark for interpolation. Well, if you want to spend 10 minutes of your time doing this calculation, I'd say it's not worth it. In an exam, I would stop my answer here and say my cost of debt is going to be 5.18%. Yeah, it's okay. So since we have already done this calculation, so no problem, we're going to get 5.17. So we'll stick to 5.17 today. Let me tell you again. Now, if you have taken, let's say for example, a different approach. If you have taken, let's say 2% and let's say 10%, answer is going to be way out. Yeah, answer is going to be way out, even if you use an interpolation method. Anyway, that's fine. So we have KD, we have our KE, and we're going to go for the value of equity and debt. Value of equity and debt using the market value method. This is the proportion. We're just trying to find the proportion of equity and the proportion of debt. Now, equity and debt. Looking at the question, we are told there is 8 million shares, which is 7.16. We'll work in millions. Is that okay? We'll work in thousands. We'll work in thousands. So 8 million is written as 8,000 multiplied by 7.16. That's going to give us an answer of 57,280. And your debt in this case, in the paragraph number 2, it states here that it's going to be 5 million nominal value, and the value of the debt is 103.42. So you have it there, no problem. So you're going to take 5 million multiplied by 103.42 per 100. Is it per 100? It's per 100 bond, right? It's per 100 bond. So I'm just going to put per 100 is percent. So giving you an answer of 5171. So you're going to get in total E plus value of D, sum up to 62,451. 62,451. So now we are ready for the final part. We're going to nail it. We're going to get cost of average cost of capital. Write the formulas. Cost of equity into equity over equity plus debt, plus cost of debt, which is always, remember, 1 minus tax rate. You're going to take your debt proportion, which is written like this, and we're going to put in the figures. We have got 12 just now given by the question. Equity, you can find the percentage here if you want to. Yeah, you can find the percentage here. If you're going to find the percentage, it's simply going to be 62,451. It's going to be around 92%. Yeah, it doesn't matter. 92% and 8%. Yeah, if you want to use percentage, fine, go ahead. I will give full credit for that. 57,280 divided by 62,451 plus cost of debt. Now this is after tax. It has to be after tax, and our calculation here that I've done here is using an after tax element. Yeah, this is already an after tax element, So this is actually an after-tax calculation of cost of debt. So we'll just put in 5.17 or 5.18, whatever method we have used. So you're going to get 5171 divided by 62451 multiply plus, you're going to get something like 11.43%. So this is how we do this part of this question, which relates to WACC. And we just earn ourselves hard-earned 5 marks. Okay, we just got 5 marks for this. Now the last part, sorry, the second last part, which is the last part on the calculation bits, is going to be calculate the project specific for the venture, and it's going to give you 4 marks. This is risk adjusted WACC. We have not read the question proper, but let me just start the question by saying part D, project specific. It's not project specific WACC, and it's project specific cost of equity. So this is project specific cost of equity of cards company. All right, the project specific cost of capital, sorry, cost of equity is going to be, we're going to say, find this when business risk changes. Okay, but financing proportion does not change. Yeah, financing proportion does not change. So when you write this, you're simply getting ready for P4 examinations next time round. Okay, does not change. You should know when you use a project specific WACC. It's only done when the business risk changes, but financing element is the same proportion. Okay, now there are 2 steps of finding project specific cost of equity. The step 1, it's simply going to be ungear the beta equity of whatever proxy company that is given. Yeah, ungear the beta equity of proxy company that is given, and we are told in this case in paragraph number 3, card company is planning to invest a significant amount. Yeah, you only find if it's significant, the project is material. Yeah, of the money into the new venture of a new business area. It has identified a proxy company with a similar business risk. The proxy company has an equity beta of 1.0. So careful, the keywords are equity beta. We want equity beta. That's what we're going to ungear now. And their equity is 75 proportion. The debt is 25 proportion. And assuming that that business also pays a tax of 30%. Yeah, same country, most of the time it is, because here the examiner only said card company pays profits for 30%, so that company also pays a tax of 30%. Now beta asset is equals to, using a little formula here, beta equity multiplied by equity over equity plus debt. Now there's a tax savings when you take debt, so we'll have 1 minus tax in here. And I'm just going to put a comma and just continue by saying beta debt is assumed to be nil. Okay, you don't have to continue that formula in F9. Yeah, beta asset is equals to beta equity and this formula, and beta debt is assumed to be nil. So we are told the beta equity. Now remember, this has to be the proxy company's figures. 1.038. Equity 75. 75 plus 25 multiplied by 1 minus tax. Assumed to be 0.3. you're going to get here the figure of, when you put in across the calculations, you're going to get here 842. Tell the examiner, what is this? This reflects the new business risk only, which means they have removed the financial risk. In here there is business and financial risk. We have removed the business risk, sorry, the financial risk out. Now the next step, what are we going to do? Step 2 is going to be re-gear to card company gearing level. Yeah, we're going to re-gear back to card company's gearing level using the same formula. You don't have to write the formula again. One time is fine. 0.842 equals to beta equity over equity. Now the equity, we got it from the valuation here, 57280, 5171. So putting in the figure, 57280 over 57280 plus 5171 multiplied by 1 minus 0.3, your tax rate. Calculating it accordingly, calculating this figure, multiply with this figure, divide by this figure, you're going to get a beta equity of 0.895. So once you got 0.895, last step is going to be a cost of equity, which is going to be your RF, which is 4%, plus your RM and RF, which is given here as 5%, equity risk premium, multiplied by the beta equity that you have just got, $0.895, which you should get an answer of cost of equity, which is 8.5%. Now, this is your answer. This is your answer, and you have finished this part. But just to make some comments, just to make, they didn't ask us, but just to make some comments. 8.5, we got just now cost of equity using this method. Existing business cost of equity is 12%. So the beta is 1 point, how much? Our existing beta was 1 point something, correct? Our existing beta is 1 point something. The new business beta is 0.895. Cost of equity also fell down. So I can come to say that this new business is less risky than its existing business. Okay, this new business is less risky than its existing business. That will be the answer for part D. Now, continuing with the last part of this question, discuss, let's get these 8 marks, okay? Let me briefly give you the answer for these 8 marks. What you need to write for this. Discuss whether changing in capital structure. Can you change your capital structure that will lead to a reduction in your cost of capital and eventually will increase your value of the company? So, is capital structure relevant? That's what they're trying to say here. So, let me see this part of this question. Capital structure for F9. Just talk very briefly about a few theories. The first theory that I want to talk here is going to be Modigliani and Miller no tax proposition, 1958. Now, in this proposition, Modigliani and Miller assumed that we lived in a no tax world. And they have concluded in this particular model that as you go on, this is going to be your cost of your capital, this is going to be your gearing. Okay, your gearing. What's going to happen here is that when you borrow your K WACC or your cost of capital remains the same. Now if your cost of capital is going to be the same, and when you do a project, your NPV will be the same. So what am I trying to tell you here is that if you have a project with such IRR, this is your return of the project, and you are now discounting at 20%, this is going to give you your NPV. Okay, so we're trying to link the question here. One is going to be capital structure, cost of capital, and also increase in value. Now when you borrow at the moment at this level and you got a cost of capital of 20%, and you try to change your capital structure by borrowing a little bit more, you try to change your capital structure, let's say now you are 20%, and you try to change your capital structure and you borrow more or you borrow less, and it's still going to be 20%. So what conclusion can I make? My new cost of capital will still be 20%, and my NPV will still be the same. Right? New cost of capital is the same with my old cost of capital, and my NPV is going to be the same. So I'm going to say my NPV is going to be the same. So I'm just putting in pictures. Of course you got to explain. You got to explain clearly. NPV is going to be the same, cost of capital is going to be the same, therefore NPV is going to be the same. Now when my NPV is going to be the same, and you must know that the wealth is reflective of the NPV, the value of the firm or the value of the company will remain the same. So what's the conclusion M&M have said? The conclusion is that this is a simple conclusion. It does not matter. It does not matter how much we borrowed. Yeah, capital structure does not affect shareholder wealth. Capital structure does not affect shareholders' wealth maximization. So any amount you can borrow, it doesn't matter. 1958, no tax will heavily criticized because of the assumption that you don't pay tax. So they came up with the second proposition a few years later. They come up with this proposition, tax world proposition. And they have concluded, which if you go to P4, you can see this computation in P4, but you don't have to know in F9. You just have to know briefly, this is going to be your gearing, okay? This is going to be your gearing, D to E or whatever proportion. This is going to be your cost as well as your value of your company. I'm going to do it. What's going to happen here is that this is going to be a conclusion. Your cost of capital, weighted average cost of capital, will start to fall the moment you borrow $1. Yeah, it's cheaper cost of capital simply because of tax savings as a result of paying interest. So your KWACC, your weighted average cost of capital, will go down as you keep borrowing. Therefore, so now coming back to this one, I'm doing the same project. Yeah, I'm doing the same project, and my cost of capital now fell to 15%. So what's going to happen is that I will experience my NPV, if you can see here, it's going to go up. Yeah, I will experience my NPV, it's going to go up. So my NPV, it's going to go up this way as you keep borrowing. NPV goes up. When your NPV goes up, eventually your value of the firm. The value of the firm is going to go up. The value of the shareholders is also better. So what's the conclusion here? Conclusion here is borrow as much as you can go. Yeah, borrow as much as you can. Shareholders' wealth goes up by this. So the conclusion is gear up 99.99%. That's a very bad assumption. Is that clear? I mean, that's a very bad conclusion. Borrow as much as you can. But this theory underlies with a few assumptions. Yeah, the few assumptions that you have to explain is that it works only on a perfect market. There's no transactions cost, moving your capital, yeah, borrowing and all that. Debt is RF, which is always constant, which is not, and you will never have any bankruptcy costs as a result of you keep borrowing. So write something like that and explain a few sentences. Make sure you explain the sentences like what I've said just now. Next one is going to be the third one, which is, let's just stop at this one, traditional view. Now, traditional view, cost of capital, gearing, as well as valuation. Alright, let's stick to cost of capital here, I think. Okay, that'll be good. And this is how it behaves. This is how your KWACC behaves. Now, what is important here, it's not a smooth curve, okay. Okay, this is what it behaves. It behaves in this manner, where the lowest point is going to be the best optimum gearing or optimum debt level. This is going to be your optimum capital structure. This is going to be your optimum capital structure, i.e. at lowest WACC. This will be your lowest cost of capital. When you're having the lowest cost of capital, if you can go some more lower, what's going to happen? Your NPV is going to be higher. So you're going to say your NPV will be highest, and therefore we're going to say you're going to have the highest firm value. Yeah, we're going to have the highest firm value. So this theory says that, yeah, it is important to have the right capital structure. This theory says that, well, it's important to borrow as much as you can, so capital structure is relevant. This theory says that, well, it's not going to be relevant because of the WACC is going to be constant and all that. So more or less, this is what you have to answer for this part of this question for 8 marks. So that's the end of this question called Card Company. I wish you the very best in your coming results. Good luck, everybody.